A little bit early. Got my hair cut this morning.
Good, man.
I love that Gray Clips opens at 8.
That is nice.
Yeah. There's you.
Come in.
Go check on the audio.
Better drop my volume down here.
Paul Winterowd's going to be the guest.
Nice.
Hopefully.
Oh, why aren't you working on our loan right now?
On it right. Did you see that this morning?
He did, yeah.
Well, this could be a short meeting. Hey, Paul.
Good morning.
Good morning.
Can you hear me okay?
Totally.
Good.
Yep.
Hey guys,
Hi, Chelsea.
how are you?
Great. Fantastic. I'm just texting a couple of our regulars this is only the second time we've done this in this time slot. So I think people are still getting used to it.
Hey, Paul. Hi, Chelsea.
Good morning.
How are you?
Hi Carl, hi Paul.
Good, thanks.
Good, good. Yeah, we got some of the crucial information to you this morning.
Yes, we're making progress.
Yes, it wasn't without a fight, but we're getting there.
Hard fought these days, it just seems like everything's hard fought.
Yeah.
But
are you finding that a lot of deals right now are kind of, having a lot of bumps in the road?
yeah, it does feel that way. That's why I said that. It's just this added layer of scrutiny, it seems, with COVID. So it seems like they're more meticulous about dotting all the I's and crossing all the T's than previous, or just asking for a few more things. And
well, and that's
so,
kind of how it happened after '08. It got real tough for a while.
yeah.
So, banks like to be careful.
Yeah, we're getting stuff done though. So
It's good. Great.
So, Chelsea, just so you know, if you don't already, Paul's doing the loan on Aspen Park.
Oh, I did not know that.
Yeah. Yeah. So he's our, I hesitate to call you a broker now because you corrected me so many times.
well, that's fine. People can wrap their head around that. So
It's
mortgage broker is
mortgage,
easy enough.
Yeah, but you call yourself, was it wealth advisor? So
A capital advisor.
capital advisor. Right.
And are you local to Salt Lake City, Paul?
Yes. Actually, born and raised. I grew up in Murray. I live in Salt Lake now, in 9th and 9th area. Our office is downtown. Nice thing is, we really don't have any boundaries, other than the country. So we can do deals all across the country. So
Good to know.
yeah.
Yeah. So this is the second loan that we've done with Paul. The first one was our 44 unit in Albuquerque that didn't end up closing, but we got way down the road on that one. And, I think we did, didn't we? We got to passed an appraisal on that, I believe.
Yeah. Oh yeah.
So we were at our approval deadline essentially. And it was like the approval deadline happened to be about the exact same day that the stock market dropped whatever 10% or whatever crazy amount it was.
It was right when COVID started getting serious.
In
everyone's mind.
Everybody was panicking all of a sudden. So, and Paul and who was it, Paul? It was Arbor.
It was Arbor, yeah.
Yeah. Couldn't really, couldn't tell the future, right? It was like, what's going to happen here? And so our seller didn't buy it. He just didn't see the urgent, like the emergency kind of situation. So he wouldn't give us any more time, and we ended up bailing on that. But in essence, Paul took us through that whole process and is super fantastic to work with. So I was hoping a few more people would join us, Paul. But we can just kind of chat. I didn't have anything.
Sure.
I didn't have anything real formal in mind at all. I wanted everybody to meet you just because we've had such a positive experience working with you, and I also think that you, being an investor yourself, bring a really valuable perspective to the conversation. So
sure, thank you.
Yeah.
If you don't mind me asking, what type of financing did you get on Aspen Park?
So we're doing a bank loan, and the reason we went that route was really twofold. One, to push leverage, and also to include rehab funds. So one of the strategies that we find works really well on value add type plays is a construction loan. Even though it's already existing property, when you go in to add the value, there's obviously some capital investment there. And the other reason is income is typically low in those sorts of opportunities. And so on a typical perm loan, we have to underwrite to the in-place income. And that would have put us down at probably like a 60% loan to value, and that wouldn't even have included the rehab funds. So structuring it as a construction loan, we can look at a loan to cost and what it will be once the work's completed. And so we could do an overall 75% loan to cost on it. So it probably cut the down payment close to in half, I would guess, between the down payment and the funds necessary for the rehab. So it just helps push the leverage
How much
more.
of the construction loan did you finance? 75%, the same as the property, or 100%?
Correct. So the best way to wrap your head around it is it's an all-in type approach. So we'll look at it, the purchase price plus the rehab, and that will give us our cost basis, and then we can do 75% of that, assuming on the appraisal it will be 75% or more, or less rather, of the value. So as long as the after repair value comes in above the cost, we're good. So that's how it
Sounds good.
worked out. Yeah.
Getting it done.
Yeah, and I don't know, Chelsea, if you know that it actually appraised for 2.4, we're under contract for 2.25, and appraised for 2.4. So, and then with garages, which was our original proposition before townhomes, it appraised for like 3.1 something, just by adding, $150,000 worth of garages. So it's an interesting deal, because it kind of got better and better as the more we dug into it, and the more the more we really got in touch with what all the possibilities looked like. It was like, wow, this is better than we thought it was. So pretty exciting. So
always good.
Yeah. So Paul, remind me again, you guys have a place out in, you're involved in a building out in Tooele, aren't you? Or Magna, one of those.
Correct. Tooele.
Tooele, yeah. Okay.
I'm a passive investor on that, but yeah, I don't know if you had a specific question about it, or.
Well, I just kind of wanted to get a feel again for your experience directly with investing too, because like I said, I think that's a really powerful perspective to have. Most brokers and bankers aren't going to have necessarily the GPLP thing down and whatnot, right?
Yeah, I can give you a quick summary, cliff note of how I got involved. And it really started for me by buying a fourplex, just saying, hey, I need a place to live. Instead of buying a house, I'm going to buy a fourplex, live in one of the units, and figure it out. So I started, and this was probably 8 years ago now.
Oh, wow.
Somewhere around there. And
saying, oh, wow, because you're such a seasoned professional at this point. So
yeah, I was a little sluggish to get going, really, even though I had a lot of interest in real estate. But that's how I started cutting my teeth and managing it, fixing it up, doing that, and I've tried to focus on good locations. I mean, they say in real estate, location, right? But that served me well, and really fell in love with multifamily as I really started to understand it and wanted to do get more involved, and that really led me to Bonneville. Made a bit of a shift career-wise, and just felt like, hey, the best way I can learn the inner workings of the multifamily world is to be doing mortgages. And so I jumped in, really immersed myself in it, and not too long after, the first multifamily deal I did was actually 2 properties in the Avenues in Salt Lake, across the street from each other, a 7 and a 13 unit. both around 100 years old, very heavy value add, down to the studs, some reconfiguration of units and layouts and in a lot of cases, and very intense project. After that, not too long after that, bought a mixed use building on 4th South and 4th East, about just north of 4th South. It was like 3rd South and 3rd South and 4th East, and it was a typical brownstone apartment building layout, but it looked like it had some office space and some studio apartments, and again did a heavy reconfiguration, and we did 24 micro units, and so it was 4 levels, and we put 6 micro units on each level. And so again, very, very intense construction project, but we did both of those and have exited those and did well. And I've also, as a GP, bought a property in Missouri, Springfield, Missouri. I came about in somewhat of a unique way. It was a client of mine that was doing a 1031. This was a property that he had identified on his list of 3, and ended up going a different direction, but had done some work on it and still made sense. And so purchased that. There was some land involved in that, and our plan was to go vertical with that, but just that stalled a little bit. So we're trying to figure out, I mean, with COVID, if that's still going to make sense or what we're doing there. And then also got a property, a 23 unit in Boise that was initially going to be a heavier value add. It was 70s vintage and needed some updating. And when we went in, it was just undermanaged. It was still a clean property, and we did some real minor cosmetic things, and we're able to hit our budget and our pro forma without doing the heavy lift. And so which was great. It was super nice to do that, and I think worth consideration if you can find one of those tired sellers that's undermanaged, and you don't necessarily have to do a huge rehab to get to where you need to be, and could leave some meat on the bone for someone else or do it. But we tested a more intense remodel on one of the units, and we just didn't get much more rent out of it. So it's an iterative process, as you go through. Do you have a question or comment there?
Yeah. So I was just wondering if you think, I mean, Boise is one of the, depending on where you read or whatever, like one of the top 3 markets in the country right now, or something like that. So are you in an area, like a submarket in Boise, that is going to be like high growth, or you anticipate those rents going up pretty quickly?
Yeah, I feel like we've pushed them for what it is, and I think just some typical 3 to 5% increases at this point with what we've done, but it's right on it really is downtown Boise. So it's a great location. If you're coming into town off the freeway, like the main freeway entrance into Boise, like downtown, it's really a quick right and 2 blocks there. So it's somewhat on the edge, but it's really close to Boise State and a great park area and the river up there. So it's a great location there.
How'd you find that one?
I am not the guru. I have partners on all these deals, and partnered with Tyler Kohler on that. And he was looking at it and needed some help putting together the equity, so brought me into the deal. So he really had sourced that.
Okay.
And then, aside from that, there's only so much time and there's only so much energy in the day. Right. And especially the heavy value add take a fair amount of time and bandwidth, as you know well, Tate and Carl, and not sure everyone else's background on here, but as we've exited a couple of these deals and taken profits, I've done some more limited partner, some more passive investing, and I get that. It's funny, as I got into business, it's like, why would I ever want to do that? But I think there's a ton of value in that, because it truly is passive. Yeah, you're going to make more as the sponsor, but you're going to put a lot more into it. There's a lot more stress and effort and time and sleepless nights and all that. And pick your poison. It's not that I won't do that or continue to do that to some extent, but I'm spreading out my money, diversifying, and just seeing how other syndicators do it is very valuable as well. Even if the end goal is to be that, GP, you can learn a lot by seeing how other people put their deals together and see how it works. And
yeah,
so that's, and I'm in, it was nine syndications that I'm an LP in. So that's been good as well. It's far less taxing, and it's good to tune up the skills as well. And
I don't think there's any doubt that the ultimate crown in this industry is being the passive investor. That's it's the easiest and very lucrative. Like you said, it's maybe you're not making as much as the GP necessarily, but talk about leverage and having your money work for you. And to me, that's being the smart money in the room when you know what your money's worth, and you've got the ability to pool, 300, 400, 500,000 or whatever it is into a deal, and you can, you get a chunk of the deal,
Yeah,
for sure.
Well, and I wish it was that much per deal. It's more drop a zero, more than 50, 75,000 tranches. Okay. But
gotcha.
just from a risk perspective, you're not going to get them all right. Something's going to go wrong, yep. And so just from my perspective, if I can get in different markets, different syndicators, hopefully they all go well, and you do your best. And I do think it's hard to fail in this business. It's not easy, but it's a great space to be in, the multifamily space. And you have to be really negligent, I think, to completely fail in this space, which is nice. But yeah, I think at least for me, a little diversification at this point is feels right. Especially given some uncertainty as well.
Yeah, that's awesome. So you're a GP still in that Missouri deal, right?
Yeah, I'm Boise, and so the two Salt Lake deals we've exited.
Okay, gotcha. What about Tooele?
So Tooele, that's one of the deals I'm a limited partner in, and You know, that's gone really well. Again, I've had a front row seat. I've participated in the financing for that as well. In fact, I've got some IRA money there, but so I'm probably more aware of that, of the inner workings of that deal than some of the others. But it was I'll tell you this: the city of Tooele, there's some opportunity out there, but the actual workers in the city are tough to work with. They've been sticklers. It was actually it's the Kirk. It's actually we got it on the historic registry because the city wanted that, but it was a bit of a landmark hotel and an old building, and people stayed out there in a hotel perspective. And it was when it was acquired. When we acquired it, it was ran as a hybrid. Really, there was some nightly stay or some extended stay rooms, and then some apartment rooms, and really had been run as primarily an apartment building for 30, 40 years. And so when we were doing a refinance, a Freddie Mac refi, there's, you know, they uncover all the stones, and they found out, well, hey, this property is not zoned for multifamily, it's zoned for hospitality. We're like,
Uh-oh. We lost Paul, I think. Hey, Paul, we lost you if you can hear us. You're frozen, bud. Bummer. Maybe you'll dial back in. How's it going, Sean?
Hey, what's going on, everybody?
Good.
Sorry about yesterday again. My bad.
All good. Yeah.
What did I miss at the beginning? Did he talk about kind of the mortgage market right now?
No, we haven't.
sorry.
Oh,
Did
you're
you
good.
lose me?
We lost you. Yeah, for probably the last minute or minute and a half, something like that.
Oh, really?
Yeah.
Okay. Sorry about that.
You were talking
about.
You were basically saying that the last thing you said was that the zoning was for hospitality and not for multifamily.
Yeah, so we had to go through this long song and dance we had to get the property on the National Historic Registry. They said, okay, once you do that, we'll approve it. And then they came back and said, well, we're not sure you've got the right parking for multifamily, and got to have the fire marshal come in and do a full survey of that. So there's just been one thing after another, but we did get the zoning changed and finally moving forward. But that's the thing about multifamily. There's always new surprises. You don't necessarily know what's coming, but otherwise, the property was really poorly managed, tired seller. There was a fair amount of drug use going on, and drug deals, and allegedly prostitution, and that's all been cleaned up and really made it a nice property. The rents have been strong, and the values probably created about over $1 million of equity, and that really wasn't me. I wasn't in the trenches making that happen, but that's from the costs and the new appraisal. That's how it's shaking out.
What cap rate is it? What cap rate is that valued at?
I should know. I want to say it's like 5 3/4.
Oh, that's okay. So cap rates are a little higher out there. So just so you guys have a frame of reference, Tooele is like at least 45 minutes from downtown, and it's way out west on actually the other side of the mountains from that divide Salt Lake from this other valley. So like I've been there maybe twice in my entire life. There's no reason to go out there at all, really, to speak of, but it is growing, right?
Yeah, it is. And it's actually, you know, it's a unique little community, but it is growing, and really a bedroom type community, like certainly easy to commute into Salt Lake.
Yeah.
There's good freeway system, and so
Yeah.
the real estate's a little cheaper there. So if someone works the west side of Salt Lake Valley Airport, it'd be a great place to live, a little quieter, slower pace
The
out
Salt
there.
Lake, the Salt Lake housing market is interesting because it's got like it's such a directional like growth pattern where you've got essentially forced growth to the north into Davis County up towards Ogden, forced growth to the south towards Provo and Utah County, and you're kind of confined by the two mountain ranges, but there's little like offshoots of like where the market is growing based on that it is within an hour commute of Salt Lake. Like Ogden is, I think, going to become one of those that, right now in Ogden, you can still buy 4-bed, 2-bath, single family house, 2,000 square feet, 2-car garage on a quarter acre for like, maybe 300,000. If you're shopping hard, you can probably get even better than that.
Yeah.
And land is like abundant up there as far as infill projects go, and still very affordable. So to me, that's that's a exciting proposition. Our Clearfield project is like probably 3/4 of the way from Salt Lake to Ogden, I'd say. So we're right in that path of progress for sure.
Yeah.
So, Paul, what are you seeing in the markets? I mean, what are you seeing in terms of like just people's moods and lenders' moods and that sort of thing right now?
Yeah. Thanks for asking. So it feels like, generally speaking, we're taking baby steps back to normalcy. We're not where we were, say, January, but we are inching back towards that. So on a banking level, like local and regional banks, and the most of my exposure is in the Utah market, in that regard. But there's a lot of requests for new construction, which
Right.
is interesting, because there's a lot of projects still that are in the works. There's going to have a lot of deliveries, especially in the downtown area, but developers still want to march forward. So there's a lot of new construction requests, and those deals are getting funded. Some reduced appetite for some of the real big players like your Wells or Key, those sorts of players, but the local lenders are still in the game. They may come in at 70% or 65% of cost rather than 75%. I heard Zions is capping their construction at 60% of cost. So still doing deals, but a little more conservative. Need to bring a little more equity in there. And then on the stabilized stuff, there again, local banks, credit unions are showing an appetite for purchase, acquisition type deals, or rate and term refinances. Really not interested in cash out type scenarios. So local lenders really haven't warmed to maximizing cash out or even providing much of any cash out. So perhaps you could, if you owned a property free or clear, a local bank might go 50% today, but certainly not going to 70-75% on a cash out basis. On the on the agency side, like the Fannie Freddie world, really actually going quite strong. There were some credit overlays and some COVID-19 adders, if you will. The main thing was they're requiring initial reserve deposits to cover any potential shortfall
Yeah, I was going to ask you
in
about
rent
that.
collections.
Yeah.
So depending on your leverage, it can be anywhere from 6 to, well, if you're at a 55% leverage, there really isn't any reserve requirements, but anything north of that, there is anywhere from 6 to 18 months, and that's a principal and interest. So it can be a healthy sum.
Yeah.
And you mentioned the deal in Albuquerque. I think that was going to be one of the
Right.
the curveballs that was thrown at us. We'd have to come up with some reserves for
Yeah.
that one. But that's, again, snail's pace, but some of those requirements are loosening. I do think that the second half of the year is going to be telling with the election, and as some of the stimulus burns off. Like, by and large, multifamily has stayed strong. Collections have stayed strong. There's definitely been some softening, and standard rent growth may be stalled for about a year. So we'll see how that plays out, especially this second half, and that's why I think these reserves have remained in place, just to see, okay, what are some of these longer term effects, and if we're not being propped up by the government, can we still sustain ourselves in these properties? So we'll see how that goes. But rates are great. I would say 3 to 4% is where you're going to be if you're that lower leverage on a larger deal. We're seeing close to 3% on rates. When I say larger, we're talking 6-7 million or above. And then if we're at like 55-60%, but if we're at that 75% mark on a small balance deal with a step down prepay, you're going to be close to 4%. So that's the range, just depending on how it's structured. But one thing that I had to do a bit of a reframe on around this reserve was, hey, it is what it is. And if you are going to do CapEx, then you're just delaying some of that CapEx work until you can get those funds released 9-12 months down the road. So because you need those funds anyway for the improvements, and really it's just pushing it out a little further. So I've seen some pretty large, sophisticated, experienced syndicators take that approach, saying, hey, well, if everyone's scared of this, we're going to move forward, and we'll just, we'll get these funds released 9 months down the road, and then we can either continue on or start some capital expenditures with those funds. So like anything, there's a glass half full and a glass half empty with it. But given where rates are, that's there's increased activity, and another structure that is becoming more and more popular. And this really doesn't apply to the small balance space. So we're talking, again, the 6-7 million and above, but it's actually a floating rate deal. And so the big challenge with Fannie Mae in particular, and Freddie Mac to some extent as well, because they both the best pricing, meaning the lowest rate, comes with a yield maintenance prepayment penalty. And so
Yeah,
that really means you're either someone has to assume the loan, or you're going to have a pretty healthy prepay
Right.
if you're trying to get out of this in 5-6 years. And so that can prevent you from exiting or moving on or doing what you want. So this floater structure where the rate isn't necessarily locked, it does float, but we buy an interest rate cap so that you do have a cap on how high the rate can go, and there's just a 1% exit fee on that whenever you want. So if you want to sell it 4 or 5 years down the road, you know, you have this 10-year loan, you have a cap on interest rate exposure, but you don't have that prepay. And so that hasn't made it into the small balance space. And when I say small balance with agency, again, that 6-7 million and below mark, but above that, that's becoming a more common approach because interest rates seem to continue to fall, or people may want to get out of a deal before 10 years down the road. And so it's a nice approach. But
Who's doing those?
Those are Fannie and Freddie.
Oh,
So
they are.
Fannie is, I've heard rumors that they're trying to catch up, that their program is such that just some underwriting standards. It's quite uncommon. It's typically a Freddie Mac deal that those are running through, but I've heard some rumors that Fannie's taking note and revamping their floater program. So we'll see. There may be some news on that front over the next couple months, and maybe that will creep into the small balance space as well, which would be really interesting if it did. So
Heck yeah.
fingers are crossed. Fingers are crossed on that
I mean,
one for me.
one of the takeaways is we need to go find a $6 to $7 million plus deal size.
Yeah.
Right.
There you go.
This group right here on this call we can definitely get deals done. There's no doubt about it. Chelsea's a deal finder, a capital raiser. Sean's primarily a capital raiser. And then of course we're just looking for deals all the time ourselves. So yeah. It's a good little,
but to wrap that up, just chatting about the markets, the CMBS space is really stalled. There's not a lot going on there. It's funny. It seems like it became viable for about a year or two. They were really sluggish to recover from the 2008 downturn, and then that market just got scared quick, and so hasn't been real competitive. Insurance companies have been quite conservative. Multifamily is still on their radar. Self-storage, but like office, retail, especially retail, hospitality are real tough at the moment across the board. But and HUD actually locked a HUD loan yesterday, a rate lock on a HUD loan refi up in Bountiful, and the note rate was 2.31. So hard to believe.
rate and term refi. Is that a rate and term refi?
2.31%. Yeah, that's actually a cash out refi. So
Oh wow.
he's pulling about 3 million out. He was lower leverage, but he's getting about 3 million out. So the HUD loans are a pain in the rear. They're not easy. It takes a good 6 months if you're efficient, and there's some brain damage, but I think, and that's on a 35-year amortization as well. So I mean, just from a cash flow perspective, it's something special. I typically wouldn't recommend doing a HUD loan unless it's about a $5 million deal. You can go lower, but just when you compare the costs and the effort compared to a Fannie or Freddie on you know, I don't think it's necessarily worth it until you get over that $4 or $5 million mark. But it's almost free money. I mean, I'd say that a little tongue in cheek, but I mean, 2.3%. It's
Yeah,
hard to
that's
believe.
awesome. That's awesome for sure. Right on. Well, do you have predictions? What you see how you see things going? I mean, I think this is like,
Sure.
this is
It's like
the-
it's like the old pro forma disclaimer.
yeah, right.
It's like the old pro forma disclaimer. The one thing we know for sure about any pro forma, and I've been right about this 100% of the time, is that pro forma is wrong.
Yeah.
You never know. You never get it right. It plays out different in reality. But so, you know, I feel like 2021 maybe a little tougher year than this year. I just think some of these effects of COVID and the riots and everything are especially commercial real estate is a slow moving game. And I think we'll feel some of these effects of the unemployment into 2021. And, but I don't see it lasting much longer than that. And that's not to be a Debbie Downer or anything, but I think that may be the case. So rents may be flat, there may be a little higher vacancy in multifamily, but I do think it's going to recover, and especially nice properties. If there's anything we've learned, is that your home is incredibly important, especially if you're quarantined and stuck there. The trend has certainly been to smaller sized units. I see that potentially reversing. I think developers that make a little larger unit size, if they can figure out how to do it, will do really well, because I think people are going to want more space if there's this threat of again being quarantined. But interest rates typically don't go up in a recession period, and so I think rates are going to continue to stay low and maybe even trend lower. There's certainly people out there that are saying it's only a matter of time till we get to negative interest rates. I don't know exactly if we'll get there, what that'll fully mean. I mean, there's got to be some profit in there for investors and lenders. So there's already been floors put in place for a lot of programs, and we probably continue to see that. But all in all, I still think it's a good time to be in the business, and I like it. Certainly more than a lot of the alternatives, even in the commercial real estate space. So I don't mean to be too much of a politician. Again, I know it's an election year, and I'm not trying to play both sides of the fence, but there are definitely some headwinds, but with where rates are and you know, some investors on the sidelines waiting for this perfect time to get in, there's still going to be opportunities, and with interest rates, you know, that's probably going to continue to push cap rates a little lower. They tend to follow suit, and so I would anticipate that you know, cap rates stay about where they are, or in our markets may even continue to compress some. So that's good if you own it, and it's good for value add too. That's a little bit of an aside, but some people shy away from low cap rate markets, but those are the markets you want to do value add in,
Right.
Because
Right.
because that dollar of a rent increase means a lot more in Salt Lake than it does in Fillmore, Utah, right?
Yeah, and then in 10 years it'll mean even more, you know.
Sure.
it's like shorting the dollar during inflation, which is a whole different conversation. But I think that's fascinating. You know, you buy something now, and 10 years from now, your position on it is so much better just by virtue of, you know, inflation, essentially.
Yeah.
One of the things I was reading is that there's like probably the best opportunity right now is actually in new construction, because you can, like, Utah's a good example where you can build for another point and a half or so of a cap rate higher than you can buy existing. So, you know, Carl and I just got our butts handed to us by new construction, so we're a little shy about that. But the thought of, you know, doing something just in a completely different scale, different league, different type of builder, and different type of, you know, GC for a scaled up project sounds pretty interesting to me. You know, new build apartments is not the model that, like, you know, Corey Peterson, for instance, teaches, or really actually any of the gurus teach. I guess Neil Bawa is maybe the one that does really a fair amount with new construction. But just to mention that too, in relation to, you know, to the value add conversation, new construction's kind of like the ultimate value add. You know, you pick up a piece of land and entitle it, and, you know, right there you've created some value that you can sell if you want to, or you can take it through, you know. So,
Yeah, I
I don't have
totally agree with that. I'm curious if anyone else has thoughts or if there's any questions, but
yeah,
I've had similar thoughts, but really on a smaller scale, just really the infill type stuff, maybe, you know, 12 to 20 units, not this big grandiose project, but something you can go in and, like you say, maybe rezone or entitle and build a nice project, and it's not going to take you 3 or 4 years, and just kind of rinse and repeat, figure out that model. I think there's
yeah,
something there.
yeah. That's kind of like a next frontier. But I think, you know, whenever this new growth cycle starts at some point, I do think that northern Davis County, Ogden area is going to be just fertile ground for this sort of thing. So it's exciting to me that we have the opportunity now for value add, even in my opinion, during the pandemic, that there's still like really good value add opportunity here. And then in the future, we've got basically a small city in Ogden that's just sitting there waiting to gentrify and get hip, and it kind of already is in a lot of ways. So yeah, this is a particularly good market. And then I think, you know, the Idaho markets, Boise, and particularly like Pocatello and Idaho Falls are pretty exciting too. So, well, I just subscribe to Reonomy. Are you guys? Is anybody, Chelsea? I know you're. I mentioned it to you, but it's kind of like no excuses now, because it gives you all the ownership information for just about every commercial building in the country, and it gives you like the last transaction, the last time it was refied, the age of the building. It skip traces the age of the owners. Like it's pretty crazy how much data there is, and it's like it's $400 a month, and now like I can do searches on, you know, every building above 10 units in Boise that was built 1970 or newer, you know, and target owners directly. So I'm pretty excited about that, actually.
That's awesome.
Yeah. I'm
Did that
looking.
price come down? I thought it was more.
I think it actually has come down. Yeah.
Okay, that's awesome.
Yeah. Maybe, yeah, like I think it was like 450-ish before. But I actually really want to work with training a woman to do this calling and this direct contact with owners. And maybe I'm like, I don't know if this is just way too stereotypical or not, but my overall impression is that, you know, these owners, like I had lunch with Tim Watkey yesterday, and he says, you know, he probably gets 4 or 5 calls a week on his one apartment building called Salt Flats. And it's like, how do you stand out, you know, when they're getting a fair number of calls, and those are downtown Salt Lake calls. So there, you know, there's other areas that maybe aren't quite so hot, but I think Jessica had the success that she did have was she really kind of broke through, I think, by virtue of her being a woman who communicates well, and you know, I don't know, for some reason the owners just seem to open up to her, and it could have just been her, but I kind of get the impression that most people would rather talk to a woman in a situation like this. I don't know. Do you
Well,
guys
I
have
think
any?
they talk to, you know, generally this business is men, so you talk
Yeah.
to men all the time. And I think there's just something endearing about talking to a woman, and maybe a little bit more approachable, easier to get the conversation. I mean, I'd say
Yeah.
probably at least it's 80% men. So, and to your point, you can go on, I've talked to you about this a bit, but on Upwork, when I was looking for my VA, there's tons of people for like less than $10 an hour who specifically are in real estate that make phone calls, and search, you know, listings and whatnot. So you can certainly get a female on there who's, you know, fluent in English, no accent. So yeah, I'd absolutely look into that.
Cool. I like
And
that
I'm with you, I'm
idea.
not hiring a woman.
You're what? Say that again.
I'm totally 100% on, I think the women's the way to go for calling.
Yeah. Yeah. I know. When I call, I've got this thing in my head. I know it's a mindset thing, but I'm just another guy that they're not going to want to talk to, you know? But at the same time, like I made 3 owner calls yesterday off of Regonomy. I just kind of was like, oh, I want to see how this goes. I found this guy that owns a boatload of properties around town, and his name's Marion Wiley. I don't know if you run into him, Paul, but
Yeah.
yeah, you do
Affordable properties. Yeah.
exactly. Yeah, he does like workforce level housing, affordable housing projects. So, and he was all about like, yeah, I don't really have anything that I'm ready to part with now, but he's like, call me in a month. I'm like, okay,
A
great.
month.
Yeah, I know. Isn't that awesome? So, you know, it is amazing when you start dialing and talking to people, what can happen, for sure. Well, we're at the top of the hour here, guys. Any last questions for Mr. Winterowd? Paul, any last thoughts for us? Put you on the spot.
Yeah. If there's any questions, that's fine. I hope it's been helpful
I took a bunch of notes.
or insightful. So
Hey, Paul, I have a question. I know you already mentioned this, but I forgot to write it down. What are
Sure.
the rates on agency debt right now?
really in that 3 to 4% range. And I didn't talk about banks, but what we're seeing from banks is maybe dipping down into the high 3s, but really that 4 to 4.5 is still where a lot of the banks are. But I know 3 to 4 is a large range, but if you're looking at lower leverage, like 55% type leverage on a yield maintenance prepay structure, larger deal, you can get around 3. And then the higher end of the spectrum would be like a Freddie Mac step down prepay structure. That's around 4. What I've seen where we've been locking rates on your run of the mill deals is really in that middle 3.5 to 3.7 range on your small balance stuff, like 7 million and below.
Okay.
What's our rate on? We're at like 4.25 ish, something like that.
Yeah, it's prime plus 1, and so
Yeah.
prime's 3.25 at the moment. So on the Clearfield deal, it's prime plus 1.
Yeah. Cool. Great.
All right. Thanks.
Well, Paul, thanks so much, man. This was awesome. I got a ton out of this, actually. So we need to, we need to talk further too in the future about, potentially working with you on an equity level. And, but, one of my takeaways is that you're obviously, if you've done 9 syndications, you're an active investor, and hopefully we can get some deals done together. I love working with you, Paul. I think you're fantastic to work with.
Well, thanks.
So,
Yeah.
Yeah.
Would love to. We'll figure it out.
Sharing your email address in the chat, or you could tell us.
Sure.
I can do that.
I will chat it here. Let's see if I can. I'm on my phone.
I got it. It's Paul at BMC Capital, right?
BMF.
BMF Capital,
Okay.
yeah. .com.
Yeah.
Okay. There we go. Awesome. Well, we'll obviously be in close touch with you here on Aspen Park, but I'm looking forward to getting other stuff going here real quickly too, or shortly. So
Definitely.
yeah. Awesome.
Thanks, Paul. It was nice meeting you.
Yeah. Thank you.
Yeah,
Paul.
likewise.
Yeah.
Thanks
Awesome.
for joining.
Yeah. Cool. Well, thanks everybody for joining. Sean, Chelsea, we're on for tonight.
Yep.
Yeah.
Cool.
7:30
And
Eastern.
yep.
Perfect.
And see you guys there. And Paul, I'm sure we'll be in touch later today. If
Yeah.
so we have a meeting
Sounds good.
here, and we have a meeting here in 13 minutes with the accountants. So
Okay.
we're still working hard. I know, it's
Good
amazing.
luck.
You'll get
I
there.
don't
You'll
know.
get there.
We're getting closer, I think. Pretty dang close, actually. So yep.
Good.
All right, guys.
Okay.
Thanks everybody. We'll see you.
So long.
All right. Bye-bye.